Hello and welcome to another episode of Trading Blows from TraderX. A busy show today in what is turning out to be an incredibly busy and chaotic week for the financial markets. Huge volatility being seen across the board, obviously in the aftermath of the collapse of Silicon Valley Bank, which we'll dig into with the panel, and also as concerns spread for the future of Credit Suisse here in Europe and what the impact of that may be, both on the broader macroeconomy and also on the European banking sector in particular. Plenty else for us to dig into as well, the latest US inflation data, how that might impact Fed policy, what the ECB are likely to do this week, and also we'll have a look at the outlook for UK assets as well after the budget, which was announced earlier in the week. Without further ado, let's get into the show. So, as I said, a busy show ahead. Let's meet our panelists. A good panel joining us today. They're going to go head-to-head, as always, over 4 rounds, scoring points for a great response, and they have the threat of points being chalked off if a dispute is raised over their answer. No bonus points for the panel today, despite numerous claims and some bribes in the form of beer over the last couple of weeks. So everyone starting from zero. Joining me, we've got Ryan Paisey, the founder of PiQSuite, a market intelligence and news platform. Adam Linton, the head of the European desk at Newsquawk, who have been invaluable this week in keeping myself and I'm sure many others up to speed with everything that's going on, provision of real-time audio updates right into your ear the moment that market-moving news breaks. And David Belle, the founder of Macrodesiac, who has also been putting out some brilliant content this week via his macro analysis service. With all of that said and done, and with Ryan looking rather dubious at that last claim, let's get into the first round of what is going to be a busy show. Right. Silicon Valley Bank then obviously collapsed last Friday. Things started looking pretty shaky for the bank towards the tail end of last week. And then we had the Fed coming in over the weekend with the new backstop facility in the US, effectively to try and prevent any further collapses among regional banks over in the US. A couple of others went with it, but by and large, it seems like the issue has been, touch wood, relatively contained. But of course, we've seen volatility shoot higher across the board. Equities have traded in a choppy manner with the bears in control. But the real action, of course, has been in bonds. At the start of the week, the 2-year Treasury down 100 basis points in about 3 days. I think that's the biggest 3-day fall on record. Monday was the biggest 1-day fall in the 2-year since 1982. What I really want to dig into is what comes next. Are these moves likely to continue? Is this something that we should be looking to fade? Is this something that is likely to worsen? And really, is the best policy to try and catch a falling knife here? Or would traders be best advised to just stay on the sidelines? And Ryan, why don't we start with you, given that you're first on the panel this week?
Yeah, thank you very much, Michael. First off, I'd love to apologise for the fact that I'm now in my kitchen due to some work going on in the office. It was either sit in the kitchen or get high on the paint fumes, which not a bad option, but there you go. Anyway,
not sure how we tell the difference.
Well, there is that. So SVB collapse and the market reaction. Obviously, this is a typical panic breeds panic situation. Today, Moody's and S&P downgrading the regional banks. As always, they're watching the ball, where it goes rather than trying to preempt it. Real winners, obviously, the big banks, as always in this situation. I think it was just announced earlier on today, the vampire squid, Goldman Sachs, looks like they're going to make 100 million on profits, on a debt deal they did with SVB last week. Fed coming in, I believe they've done very well. They've, straight away, Sunday, come out and said, okay, all your money in the bank is safe. However, shareholders, you're fucked. I don't know if I can say. I'm guessing I can swear. I don't know.
I apologise for his language.
but in all jokes aside, you see what I mean?
Are any children actually going to be watching this program? A bit concerned if they are.
Exactly. But yeah, so they've guaranteed everyone's money in the bank. They've said, unfortunately, if you're a shareholder, tough luck, which is the right way to play it. Because you imagine the headlines if they start bailing out shareholders and everything else, just won't happen. In terms of contagion, I personally, and everyone loves the Hollywood answer. This is not the Hollywood answer. I don't think we'll see any traditional contagion. And I use that traditional contagion to be very specific. I mean, banks going under because of banks going under because of banks going under. What I believe we will see is much more scrutiny on the smaller so-called regional banks, which is, I say much needed for a reason, because we see with SVB, they weren't hedging interest rate risk, right? Which is, you've got to do that if you're a bank. So maybe we'll see some more banks. I know First Republic and all of that, they're under the cosh. We may see more banks be found out / go under, but that's not because of contagion from SVB. It's literally as simple as they have been kind of, being very fast and loose. So, you can argue they do deserve to be found out. So I think it's very important that traders do make that differentiate between contagion and just more oversight leads to more people that should be caught are getting caught. And I really think that's important. In terms of what the Fed does next, as I mentioned yesterday on Twitter, at the moment, we've proven that a lot can happen within a week in financial markets. We've got another week until FOMC and ECB BOE. Trying to guess what they do now is a fool's errand, because they don't know what they're going to do yet. And I wish I could say, oh yeah, they're going to cut. Well, sorry, they're definitely not going to cut. But I wish I could say, yeah, hike 25 or the hike 50, but who knows? But, the guys voting on the decision don't even know. In terms of trade, unless you have to be involved, in terms of a proper position, I don't see the reasoning why you would want to get involved now. If you're already involved now, I hope you're making money on the volatility. I would be sitting on my hands, just waiting for the dust to settle.
Yeah. No, I think that's a very rational way of looking at it. And your Fed analysis, I think, for me is spot on. And actually, Deutsche had a note out this week. I think it was Jim Reed's morning piece, where he effectively said, we haven't got a clue what the Fed or the ECB are going to do next, as you say, because they don't know either.
Yeah, exactly.
Adam, let's move along to you. What do you see evolving in the markets at the moment? Do you think some of these moves have gone too far and it's just panic setting in and we'll see a little bit of a retracement? Or do you think the rally we've seen in bonds and the lurch lower in equities is likely to continue for a while?
I think it's hard to say whether things have gone too far because the story hasn't really concluded. I think there's still more to kind of run with this kind of story. So it's kind of hard to say it's gone too far. I think from my perspective, I think there's a bit more idiosyncratic risk within the US banking system. These were banks.
No, you can have an extra point for the long word.
Jesus, hang on, let me go Google that one.
Just don't ask me to spell it, that's all. But they had exposure to specific parts of the US economy, such as the tech and the crypto sector, and their business models are relatively different to those of the traditional banks, which take in deposits and then lend out loans. A lot of the clients of these banks had already had large cash balances anyway, so didn't need some of the traditional banking services, and therefore they got exposed to interest rate risk when they started buying longer duration assets. So and then therefore, since we've kind of seen some of these kind of collapses, the US banks have benefited. We've seen like JP Morgan and Citigroup take on high levels of deposits. There was the story in the FT overnight. I think Bank of America, they've taken in $15 billion. So I think from the traditional banking perspective, then when you ally that with the bank term funding scheme and the deposit protection, I think the dust will eventually begin to settle on this. And I think regulators have done kind of what they need to do for now. I think, financial stability risks have taken front and center. I think one thing you've got to remember as well, we've been in the Fed blackout period. So I can think, we've not had, these Fed speakers on the wires every day tell us what
they'd be desperate to, right?
I know, I missed them a lot. They haven't been, reaffirming we're going to do this with inflation, we're going to do that with inflation. So like Ryan said, markets are to an extent kind of flying blind a little bit here. And, a week is a long time in markets. I mean, if you look at yesterday, Fed pricing was 85%, I think, for 25, and now it's leaning more towards unchanged. So I think, by the time we get to next week, I think the economic backdrop, or at least the focus of the market, will be slightly different to what it is now. And I think the inflation narrative will kind of focus minds a little bit more than it currently is. In terms of whether this is done or not, I don't necessarily know. But the big story for today has been the European risk. So we've seen Credit Suisse get hit pretty hard. They're down about 30%.
I'm going to ask you to hold that.
Yeah.
I'm going to ask you to hold that thought on Credit Suisse, because we're going to get onto that. We've got a whole section devoted to the ECB, and I want to dig into Credit Suisse properly a little bit later on in the show. David, let's bring you in. I'm sure you've got a view on the shenanigans that have been going on with SVB and all of the fallout from it.
Yeah, well, I think the biggest thing that's occurred is the 2s-10s curve reversion is basically wiped out the inversion from 2023 in the last 3 days. And we tend to know what happens when a curve reverts, or the 2s-10 curve reverts in this way. You start to really get those recessionary risks, I guess. The recession doesn't happen on the yield curve inversion, it happens on the reversion. And this is probably something that a lot of people have been looking out for as well. We've definitely seen some more risk off buy-in, traditional what you'd call risk off. I don't like the term risk on, risk off really, but you've probably seen, especially today, the dollar's bid. We've seen treasuries turn bid again. The 2-year yield is back down. So we're seeing that front end get bid up. And so I think, there's definitely more cause for concern right now. But I think, as Ryan said, there's not really that, I don't think, contagion risk. And you know what the biggest problem is that if there were to be that contagion risk into, say, your tier 1 GSIBs, for example, what was the point in the Basel regulations or Dodd-Frank over the last 15 years? What have
and also, don't worry, listeners, if you don't know what that is, I don't either. So,
globally systemic important bank, is it?
Yeah, that's the one. Globally, I think JP Morgan's right.
Go on, then. No, go on, David. That's what it stands for. Come on.
Globally systematic important bank is the.
Oh, it's amazing how quick Google is, isn't it?
Yeah, well, I've actually got my hands right in front of me this time. But yeah, no, I think that would be probably one of the major issues, because they've obviously tried to massively rectify 2008 and prevent these things from happening again. So you could, if you wanted to, you could probably make a bit of a asymmetrical bet on the banking industry not going to crap again in the same way, purely based off of that they just can't let it happen again. In my view.
No, I think that sounds logical to me. The one other thing I want to just dig into very briefly on this before we move into the rest of the show is the way the dollar's traded has been interesting to me this week. I mean, obviously, we've seen this bid come in today as a result of the fears around Credit Suisse that we'll get onto in a second. But it's been interesting that actually the biggest driver of the dollar seems not to have been haven demand, and it's just been dragged for much of the week lower by this, ridiculously large fall that we've seen in the front end of the Treasury curve. And I guess, do we think that's something that's likely to continue? Is it a case that we'd rather be buying the yen as a haven at the moment, or do you think the dollar's going to come back into vogue a little bit? And this is panel.
I actually think what we saw yesterday and in the front part of the week was very much positioning squeezes going on more than anything. There were some big technical levels getting hit. 200 daily moving average on multiple different assets getting touched.
I think you're doing.
Sorry.
I think you're doing the moving the rates a little bit of a disservice there. I believe with Michael, I think that was the predominant driver, was just a lot of interest rates getting repriced.
I think at the start of the week as well, stocks are holding up a lot better, whereas today is kind of been more a case of pure financial distress, which has benefited the dollar. But I think at this time in 24 hours, however much it is post-ECB, we might learn a little bit more as well, because I'm not sure how much the euro is going to hold up.
And also, let's be honest, by the time this goes out, this could be all out of date anyway.
That's what I said to Ryan. I was like, yeah.
No, you didn't say it to me, I said it to you.
People are going to be watching this saying, what are they on about? The ECB have just announced QE.
Let's make that clear, actually, before we get on to the next round. We're recording this on Wednesday afternoon. You will watch it on Thursday morning. So when things change, because they undoubtedly will, please bear that context in mind. Let's get on to the second round before we make any other predictions that will make us hostages to fortune. So, as I said, we'll get on to the ECB and Credit Suisse in a second, but I want to just dig into the Fed a little bit more firstly. Obviously, you've got the financial stability response to the Silicon Valley bank issues and collapse and insolvency that we saw over the weekend. Don't we all love a Sunday night statement from the Fed to start our week? That's never a sign that we're going to have a relaxing few days ahead. But setting all of that to one side, it's clear that inflation remains too high in the United States. We had the February CPI report this week, headline inflation coming in at 6% year on year, the core number coming in at 5.5%. So both down on where we were in January, but coming down in a very slow and bumpy manner. And of course, the headline number is still 3 times the Fed's target. What I want to know, and I'm going to come to you first, Adam, is obviously we've had this massive dovish repricing in the market. I think we've now got, again, at the time of recording, about 10 basis points worth of hikes priced for the March meeting and then cuts for the remainder of the year. Do you think this is just another example of the kind of financial distress and panic that you alluded to earlier, and that the Fed are going to carry on hiking? Or do you think this is going to put the brakes on the tightening cycle and Jerome Powell's going to have to perhaps eat a little bit of humble pie and say, we went too far too fast and we're going to ease off for now?
I think personally, yesterday, I think 25 was priced about 80 basis points. 80% chance of 25 basis points. And now it's somewhere, it was about 60 when I was last on the desk. So obviously it's a fast moving market. I expect it to be closer to 25 probably next week. But in terms of kind of how the Fed navigates this, obviously, this time last week, people were calling for 50. So to go to 0 is quite a step change. If you saw at the start of the week, we had that call from Goldman Sachs, and they suggested that we could potentially see a pause in March, but then we could see 25 basis point hikes in May, June and July. Personally, I think that's a little bit too nuanced for the market. I think if they pause next week, I think people will be more likely to price in that as terminal rather than anticipating another 325 basis point hikes. I don't think, we'll kind of get that pause. I think 25 is a safe place between 0 and 50, which we were at last week.
It's the middle.
And also as well, I think, what's that, sorry?
I said it is the middle.
Yeah. I also think, with these calls for, potential cuts or pauses, yes, the playbook that we've been kind of used to is when inflation's been below 2%. Well, we're not in that, it's a lot easier, when we are below 2%, but we're currently at 6%. So I think the Fed needs to tread a relatively careful game here. And then also you've got to bear in mind that, with inflation as high as it is, that is their primary goal here, getting that down. And there are other policy levers the Fed can pull from a financial stability standpoint. So just because they're hiking rates doesn't mean they're just abandoning financial stability. And also, when we're in the height of the financial crisis, we had the TARP program, which was an act of Congress as well. So it's not like interest rates are the primary tool to be solving everything at the moment. And when we're in a world's inflation well above 2%, I think the smart move is to say 25 basis points. They'll remain vigilant. If they need to pause, they will. Then I'm sure we'll get a barrage of Fed speakers after the Fed decision to kind of tidy anything up.
Yeah. No, I would personally completely agree with that. Go on, Ryan.
Can I throw it? Obviously this is trading blows. So can I counter punch my good friend Adam Linton? Personally, I think they should hold fire. The reason being is, what the next meeting is May the 3rd. It's not that long ago. It's not that long until May the 3rd. They've got a chance to pause, take the opportunity. We keep getting told by everyone that the impact of raising rates lags, right? So this give the hikes we've already done. Let's give those lags chance to catch up. And then we might see in 4 weeks' time or 5 weeks' time, whatever it is, that we actually didn't really need to hike now anyway. There's we can't keep saying, the impact of hiking rates hasn't filtered through to the market yet, and we've got the opportunity and a reason not to hike. So let's give those lagging, that lag chance to kind of the pre-done hikes work its magic in the market. It just seems to me a bit bonkers that so keen on hiking still. It's I'm not saying
it wasn't a high conviction call of mine. My balance of risks is clearly between 0 and 25.
Well, okay, so here's a great one. So what's to stop them doing a 12.5.
Oh God!
I think that's just too obtuse for the market. I think
obtuse.
Is the message in there would just be too mixed. But I think we both agree they don't do a cut. I think a cut.
Oh yeah, no.
I think that would cause more harm than good, because I think that would be too much of an admission of the financial fallout. I think we can agree on that.
Also, it'll just show how reactionary that they are, and it'll be a joke. If they did cut, there'll be an absolute laughing stock.
Most certainly. I think Nomura are a long way wide of the mark with that call. Also, David, I want to bring you in. I'm conscious that you've been a little bit on the sideline so far with Ryan and Adam hogging the limelight there. We obviously got 25 from ads. We've got Ryan thinking they should stay on hold. Where do you fall, between those two? Which of those views are you leaning towards a little bit more?
Well, I don't think they're gonna hike. I think they're balancing out the longer term context here as well. If you consider how the Fed funds repriced even from December, January to mid-Fed, that was insane as well. Like, there was a lot of volatility in that repricing too. So over the last 3-4 days over this Silicon Valley stuff, that's been an even, crazier and even over the short term and even more volatile repricing. And, it's probably just, people are still scared of banking crises, and at higher rates, you do tend to see these opaque risks come to light more, right? But I think what the Fed are probably going to do is they're probably going to manage this situation, maybe in a similar way to how the BOE sort of did it. I know it's probably a grander risk, this one, and the BOE was slightly different in that it was a totally different sort of product and asset class that was at risk in terms of that was my phone, in terms of the LDIs. And luckily people weren't as aware of the risks. The market was, but the general public wasn't as aware of the risks. This is quite front and center in the face. It's on the front page of every newspaper. It's even in mainstream news, that kind of thing. So I think the Fed are going to have to want to manage this risk as best they can, and without troubling the market even more with a hike. We have to remember though that NFP was still strong. Okay, unemployment ticked up a tiny bit. I can't remember the specific wage growth number, but it wasn't as strong as it could have been. The PPI number today obviously was quite weak, negative 0.1%. So there's certain things to really focus on there from the Fed's perspective that they probably require a little bit of massaging still.
David, I just want to worth notes. Sorry.
No, go on, Ads.
I think it's also worth noting that we haven't really heard from the Fed, so we are kind of flying blind to an extent. But one useful thing as well, and this kind of underscores the point that Ryan made earlier, is we haven't during the blackout period, they've used some market commentators such as Wall Street Journal's Tim Rayross as a potential mouthpiece for the market to kind of filter out their views. We haven't really heard too much on that front at all at the moment, which kind of, as Ryan said, underscores that I don't think that even they know what they're doing. But historically, wherever the market's kind of priced, they typically, unlike other central banks such as the Bank of England, cough, they kind of tend to go with what the market's positioned for.
No, I would agree with that. Just very quickly, I want to get a sort of one-liner from the whole panel. If the Fed were to stay unchanged next week, what would be your one trade to take advantage of that? Ryan, you first.
I think you buy the dip in the dollar, because I think the dollar will dip.
Adam?
We don't really offer trading advice, but I'd say
no, of course.
I was saying if you're looking at euro dollar, I'd say potentially the balance of risks would be to the upsides, because ECB need to keep going.
David?
Could you repeat that? I just had to reply to something.
Oh, sorry. I was saying
minus a point.
I was saying, mate, if the Fed were to stay unchanged next week, what's the best trade you would trade idea from you to take advantage of that in the market?
Oh, you got me on the spot there. Probably, and I'll go against this one. I would actually sell equities. I'd sell equity indices. The reason why is there would be the first signal that things aren't great. And I know Ryan's looking at me there, like me and Ryan had a little tussle. I think it was yesterday over this. I
don't feel safe between you two at the moment. After that,
basically, like I think that the bid in the market comes a little bit later than the policy response. So if the Fed has to, be more patient with hikes, it's signifying a change in their thinking, maybe. And so that might say to the market, okay, what is the Fed looking at here? Inflation's still at 6%. Why are they now pausing? That kind of thing, But that would be the bet that I would take in terms of how you could crush quite a lot of people with that.
Well, it's an interesting perspective. And before we have a repeat of the little debate that was taking place on Twitter yesterday, let's get into the second part of the show.
Next round.
So I want to talk about the ECB. It has been perhaps a little bit forgotten and overshadowed by everything that's going on, but we do have an ECB meeting this week, Thursday lunchtime. The dovish repricing that we've seen in the US has spread to Europe as well. The ECB have guided quite firmly towards this meeting being a 50 basis point increase, the third in a row. I think markets, when I last checked, and someone can correct me if I'm wrong, price around 35 basis points of tightening at the moment. So we've seen that come lower quite significantly since the SVB shenanigans took place. And now, of course, you've got Credit Suisse in the mix as well, and we can get into that in this round as well. Adam, I'm going to start with you because you're probably the biggest fan of the ECB on the panel. What are we looking for from the ECB this Thursday? What are the key things that traders should have on their radar?
Can I just butt in? I've got a thing. I believe I've got a very important, very brief point, and Adam's going to hate me for cutting in. But
I already do, mate.
Considering that, the people that we're talking to and people listening to this, I really hate this whole talk of they're pricing in X amount of points, height stuff. Let's keep it simple. It's 25 or 50. It's a 60% chance roughly of 25. This whole trying to tell people their market's pricing in 35 basis points of height, it gives people nothing. So. Yeah, so don't do that again. We're going to have words. Anyway, so over to you, my good friend Adam Linton.
I'm going to take a point off myself for not being bothered to do the maths and work that out. Adam, go on. What should we be looking for, mate?
Okay, cool. So, if you'd asked me this yesterday, I'd have said 50 basis points absolutely nailed on, because despite the ECB saying they're taking a meeting by meeting approach and a data-dependent approach, for some reason, they just flat out announced what they were going to do at this meeting, and that was 50 basis points. I probably have less conviction about that call now, but I still think they'll do it. I think from a credibility standpoint, they just kind of have to. And also, you kind of need to think that they're in a different phase of their tightening cycle compared to the BOE and the Fed. They're not quite as far along, so they kind of have more scope to potentially deliver 50 and then scale back thereafter. The problem, of course, as ever with the ECB is the decision, unlike other central banks, isn't necessarily just an economic one. It's a political one where Lagarde's going to have to form some sort of consensus between like the hawks and the doves. I think the extra mess for this meeting as well is the fact that everyone had looked towards the March meeting, not for what the rate hike would be, because 50 was just such a given at the time, but also the March macroeconomic projections, which they were going to be viewed as a template as to what to expect going forward, i.e. the immediately determined inflation expectations, how far away they are from 2%, and that was kind of giving an indication of how much tightening they need to kind of do. The problem is the cutoff for those projections was a couple of weeks ago, and the world is a slightly different place now. So those are kind of a little bit more redundant. As such, there's going to be more effort placed on the ECB's communication effort. So therefore, the policy statement and communication from Lagarde is probably going to have to, unfortunately, play more of a role than it otherwise would have done. So you could potentially see some stumbles on that point, but I think my guidance would be for them.
Potentially is doing a lot of heavy lifting there.
Yes. Is that my advice to them would be as vague as possible, data dependent, meeting by meeting, and actually mean it, whilst, being vigilant over the, financial system. I think in terms of, obviously people have got quite excited about whether they'll slow down rate hikes or not. I think, the big compromise coming at the ECB will likely be on the balance sheet if it is to come. we've already seen a lot of the hawks trial balloon this by saying, okay, well, if we do get slowed down on rate hikes, we want to speed up the balance sheet. We saw Austria's Holzman looking to include the PEP program in the QT program. So that's kind of the direction of travel that we're heading in. But I don't think that debate will kind of play out tomorrow. I think we'll get 50 basis points, a lot of caution, and then you'll get some sources afterwards saying that nobody agreed on anything.
A dovish hike 50.
In a perverse way.
Exactly. The ECB do vague and making a bit of a pig's ear of things quite well. So I guess they're probably the things we can expect tomorrow. David, I want to come to you because I'm sure you've got a view on what's going on in, well, I was going to say the Eurozone, but Europe more broadly at the moment. Where do you see the risks to European assets, both from the ECB, but also from the saga developing in Switzerland?
Well, there's always been this funny thing that's never made sense to me regarding, how they've tried to rectify the bank liquidity and the assets that they hold. Like we just had a Eurozone crisis, 11, 12 years ago, to do with sovereign debt.
You were what, like 8 years old then?
You little...
Go on, David, carry on.
I was actually 20 then, I'll have you know. And, they've tried to rectify it all, and the US has brought in regulations with regards to this. But banks are allowed to hold domestic sovereign debt in the Eurozone with no other capital against it. So it's basically deemed risk-free, which makes absolutely no sense considering
it's got risk.
Exactly, considering it was one of the biggest risks 12 years ago that nearly made the whole block go kaput. It doesn't make sense to me. And there's many people that have mentioned it. Even Deutsche Bank, ironically, have mentioned it just in a piece 2 years ago. And they said this is like, they called it the elephant in the room. It's like they've not really wanted to fix this. And, I believe it's because they want as much flexibility and as much liquidity in the Eurozone bond market as possible. And how better to get that than just letting banks hold their own domestic sovereign debt at 0%? I think Italian banks hold 194% of some sort of ratio to Italian BTPs. Like, it doesn't make any sense at all. And so you've got all of these concentrations of really crap debt, to be honest. Let's face it. Eurozone doesn't really have the best growth prospects. And it's just being kept low by the ECB, just printing and teltros and stuff like that. Like, it's just a quagmire of shite, to be honest. Excuse my French. And, that is one of the biggest risks that I see.
So with that in mind, would you be short the euro at the moment, or would you be...
He's always short the euro.
Yeah, do you know what? I bought the euro last week, and it was a really good trade, just up to...
Just lost money on it.
What's that?
I said you just lost money on it, though, but it was a really good trade apart from that.
No, I exited at 106, 106.70. I wish I ran it to 107. But not off of that. No, I wouldn't be off of that because, again, the way that I see it is it would just be back to Draghi, whatever it takes. There would be an epic sort of European ECB romantic story where Lagarde would come in and repeat Draghi, and she'd be on the front page with her stupid scarf and her leather face. And yeah, she would do whatever it takes. Euro would rally 400 ticks. Everyone would be short thinking, yeah, this is the end of the Eurozone, and they would still go on. So no, I'd be long off of that idea. I wouldn't have a trade on the euro in the short term though.
Cool. Ryan, let's go over to you.
Right. So
we've got to get you some points, haven't we? You're lagging.
I didn't want to say anything. I think I've been kind of, I think I started too strongly in the first two episodes and now I'm being punished. But anyway, first off, the only reason the market's pricing 50 or has been pricing 50 is because they're taking the word of central bankers as gospel, as in, forward guidance, we're going to hike 50. One, you cannot trust central bankers to you can't even trust what they say is accurate at the time or truthful at the time, let alone believe in what they say. And this is something I've said in a previous episode. We are wrong. Well, not we, because I'm not doing it, but people are wrong to say this is what the central bank's ECB is going to do, because Holzman, for example, has said he's voting 50 basis point hikes for the next 4 meetings. That's bollocks, right? I'll tell you what it is, because one, you can't have any faith in what they say. Two, of course he's going to change his mind if the situation changes. And I'll give you a clue, the situation small's changed since he said it, right? Again, as it comes back to what we said before, they do not know what they're going to do at the moment. I think the market, when I came downstairs from the office, it was hike 25, as we said just now, was a 60% chance. The whole Credit Suisse nonsense, don't get me wrong, they're, debit Swiss and all this, the most unfunny joke in the room. But they're perennially always about to go bust. The problem is, and it is partly the media's fault, like a headline today, the Saudis, I think the Bloomberg headline, Saudis will not invest any more money into Credit Suisse. That was read as the Saudis have given up. They've got no interest in helping Credit Suisse out anymore. That was wrong. The actual statement was the Saudis aren't going to invest more money because they don't see the need to invest more money, because they see a sound structure being built up now. And also, they already own 10% of Credit Suisse. So if they're trying to invest more than 10%, they encounter a massive regulatory hurdle. So that's the real reason. So,
I think the UBS one was more important. The CEO said they have no interest in the takeover. They want to focus on organic growth. I think that was actually probably more relevant, considering that rumour's been doing the rounds for years.
But yeah, exactly. To be honest, I would be a buyer of Credit Suisse today. I think it's been completely overdone. I'm hoping you can trade Credit Suisse on Pepperstone, can you?
Probably.
Really? Right, so Michael's now on -2 points. Just to kind of reaffirm that point, I believe, the original point, I think they hiked 25 because I think the market would 100% agree with me if it wasn't for the fact that 3 weeks ago they said, or everyone was saying they're going to hike 50. You've got to disregard what was said 3 weeks ago by central bankers. You've got to disregard what they said last week. Things have changed. Market participants need to let go of what was said pre all of this. That's I'm glad I've got that off my chest, to be honest.
I was going to say, now Ryan's got that off his chest, we can get away from the Eurozone and we can get over to the UK in the last round. So let's talk about the UK. Where do we stand amid everything that's going on? I mean, I guess, Silicon Valley Bank, firstly, the UK arm has been bought by HSBC for £1. So that all seems to have been handled, to their credit, relatively well by the Bank of England and His Majesty's Treasury. Speaking of that, we had the budget today. The OBR out the forecast saying that the UK will avoid a technical recession in 2023. Of course, we also got the increase in corporation tax to 25% confirmed, but there's going to be various deductions and expensing allowances for investment, which may perhaps soften the blow of that a little bit. I'm sure David will have a view on that in a second. The good news, though, from the budget is that alcohol duty on draft beer in pubs has been cut. And I think at the end of this week, we are all going to be feeling the benefit of that. Meanwhile, we had some decent labour market numbers out earlier in the week. Unemployment holding at 3.7%, earnings growth cooling down just a little bit. So what do we think happens next for UK assets and for the Bank of England amid all of this? We've got fiscal policy seems to be relatively stable at this point. The economy seems to be doing better than expected and the labour market is holding up okay. Do we still think the BOE are going to hike in March? Do we think that's going to be the end? And how do we think UK assets will trade? David, what's your view on all of this?
I don't care anymore, quite frankly. I'm so dejected with this country that they can't do anything else to hurt me, quite frankly.
Show me on the teddy bear where England has hurt you.
Yeah, well, they've touched me in various places. But 25 basis points, whatever, it doesn't matter at the end of the day, because with this country, the thing that we've got a massive fetish and bondage for anyway is the housing market. So they're gonna go 25, they're gonna go 50. What will happen is the housing market will dip even more, but then they're gonna do something to try and rescue it. And then we're still stuffed. We're still absolutely stuffed. Every single policy that the government tried to introduce always ends up in boosting house prices, and they're so short-sighted that they don't realize that it's a decreasing pool of people who are owning homes now. And, you know, personally, I rent because I don't want to live and pay the amount of money that you require for a house that you actually like. Like, you need upwards of $1 million to be able to live in a house that you actually like these days, I think, in London anyway. And I just think it's absolutely ridiculous. But every single policy goes back to feeding, how can we make sure that our wealth base, where everyone gets their wealth from, is supported, when really it's just a massive net welfare gain. And as I've said multiple times, like, it's the first time that I've thought in my life of actually leaving the UK, because it's just so boring. You hear the same crap constantly, the NHS, this, that, and the other. And it just seems also pointless, quite frankly.
Do you know what? It's the moaning that I get. It's just the people moaning non-stop about the UK. If you don't like it, see you later, David.
I'm happy to. As I say, you know, you can love the country, but you can hate the way that everything seems so short-sighted here. In my view, it's probably the same in other places. Absolutely.
Well, I was about to say the grass isn't greener. Like this,
absolutely.
Slightly off topic, but look at how bad France is at the moment with the striking and the pension reforms.
But France shouldn't even exist.
All right, before we get into that,
So,
Adam, the budget. Were there any big macro game changers in it, or do you just think Jeremy Hunt's saving all his fiscal headroom that he has until the next election or nearer to the next election?
Yeah, I mean, today was not a game changer. You know, back in the day, the budget used to be, a well-kept secret, but now Sunday press basically has the whole thing in there. There was no surprises. We've had a little bit of a better start to the year with regards to public finances, but ultimately, he's looking ahead to the 2024-2025 election cycle, so he's keeping his powder dry until then. Yes, the OBR forecasts were better, than some people had hoped for, but on the downside, people say that OBR is too pessimistic. So I think, that would be overly optimistic. You can't just take them at face value. I think, from a monetary policy perspective from today, if you want to have some read across, the EPG extension, that will have a negative effect on inflation towards the end of the year. So potentially does give the Bank of England a little bit of scope if they did want to potentially go for an unchanged rate next week. I don't think they will. I think they'll do one more 25 basis point one. I think inflation is still very much high, particularly compared to the US. Labour market's particularly tight. I think they do one more 25 and they say they're done. Then by the time they kind of get to May, I think we could be in a world where the likes of Tenreva is actually voting for cuts. So the moderate position opens up to stand pat on rates. And I think we're done there. I think, as you mentioned, financial stability concerns in the UK, a little bit less of a risk. Like you said, things have been relatively well managed thus far, and I think that's been reflected in kind of what we've seen. So, yeah, I think, OBR, the budget today wasn't really a game changer. It was just kind of tinkering around the edges. But in terms of what they can do, I think even by the time you get to 2024, 2025, I still don't think there's going to be too much more. I think the thing that everyone overlooks is they get very ideological with these things, saying we should cut taxes, we should do this, we should do that. It's like, well, in 2020 we paid people to stay at home and shut the economy down. That's going to be scarring the UK economy for years. All these ideological kind of wish lists that we have, they're going to have to do for still some time yet, I think.
No, I think that's a good point. Ryan, where do you stand on all of this? What do you see the Bank of England doing next week? Obviously, some pretty bold calls on the Fed and the ECB.
I think hike 25. To be honest, I think it's been underappreciated how well, the UK over the past week has not been dragged into the crapper with the Eurozone, like the Eurozone banking and the US banking. I think government obviously worked very hard over the weekend. I think they should be commended for that. And they were, before the US even, they came out and said, look, all your deposits are going to be safe. Obviously, the tech industry is something that we know government policy is really trying to build. And obviously, Silicon Valley Bank being a large part of the tech startup funding, like the funding circle. So I think they did extremely well on that front. What else? Well, in terms of the budgets, as Adam said, we knew what was going to be in it. There's nothing earth shattering. It's kind of all pretty basic. My outlook for UK assets is bullish, but then just like David is always bearish the euro, I'm always bullish UK. I think this past week has taught us this not try and look too far into the future. So these OBR and stuff, to be honest, I don't even read them. I don't even read what the forecasts are for the next couple of years, because what's the point?
You're odd.
Ryan, can I ask you? Ryan, what are you bullish about in the UK? GDP or assets? Because obviously the FTSE is.
Well, no, so when I say UK assets, I mean UK PLC. I don't mean the FTSE 100, which obviously I can't remember. I did have the stat the other episode, but yeah,
so that'd be 250 then.
Mid cap or It just in terms of just being bullish UK full stop, right? I know it's, people love to hate their own. And, if you go to America, people will say their economy's crap. People in Europe will say their economy's crap. It's just, it's human nature.
No, so it's not even the economy. It's the decisions
but at the same time, right. So, okay, when we talk about decisions, right? Truss is as to Truss's decision, ex-PM Truss. It's almost like you forget that she was PM for a bit. What they came out with was actually, a good kind of growth building idea.
I agree. That's exactly my issue. That's literally where my disgust has stemmed from.
But then that should be discussed with the kind of the trial by media and the fact that they turned around the whole process. So now you're in a position where, unfortunately, and I will kind of agree that this is not an ideal situation, but this is only going to get worse as well. But government policy isn't just what's good for the country; it's also how it will be played out in the media. I
totally agree, and this is exactly my issue. You've got people,
but then it's the same everywhere. Yeah,
well, I was going to say before we.
Sorry, go on.
I was going to say, just in the interests of time, before we get into a dissection of Liz Truss's premiership, which could be a whole show in its own. Just very quickly,
David needs to get to the airport, doesn't he, to catch his flight?
Yeah.
I'm actually leaving on Monday. I'm actually going to Barbados on Monday. So,
all right, humble brag.
Well, before we wrap up, over the next, let's say, 6 weeks, Ryan, Adam, David, which way do you see the balance of risk for the pound? We'll go left to right. Ryan, you first.
Pound higher.
Adam?
Bearish versus the euro, bullish against the dollar.
David?
I'll take the other side of both of you, just to be contrary. No, but seriously though, if we get a dump out in risk, then you've got to be bearish the pound. If we get a big broader dump, then you've got to be bearish the pound. If you get I don't think that's that stupid an idea.
Sorry, no. It was the way you say it. So you're saying if the economy goes to shit, it's bearish pound. Well, yeah, obviously.
No, I didn't say that.
No, he's talking risk in general.
I said if risk goes down the toilet.
Okay, but in that case, it's dollar positive, isn't it? So cable will go down.
There we go. Listen to me first.
Now that those two have agreed, let's have a look at the final score. Right, this is going to pose us a problem because I don't think we've got graphics for this one because there's a tie. So if you two want to play rock, paper, scissors or something to work out who wins, or otherwise you can split the imaginary trophy and the winnings.
To be honest, I'll disagree there with you, as unlike me. But I believe me, Adam, and David are all free winners because you're on -2 points, Michael. So there is that.
Well, that is very true. I think I've let myself down. I've let my family down. I've let Trading Blows and Trader X as a whole down, actually. So, I will take that away and I will struggle to get over that. And, maybe it will get to such a desperate extent that next week I won't even have a tile when we present this show. Who knows what's going to happen. Well, while I go and recover and while David goes and catches his flight, well, thank you for watching. Thank you again to Ryan Paisey from PiQSuite, Adam Linton from Newsquawk, and David Belle of Macrodesiac for joining us once again. And thank you for watching. We'll be back again this time next week and we'll see you then.